Welcome back to the Investment Conversation. I'm Andy D'Souza, Partner and Chief Marketing Officer here at Lord Abbett. As part of our 2026 investment outlook, we're going to talk with our investment leaders about key themes for the markets in the coming year across equities, municipal bonds, taxable fixed income, and private credit. Today, we're speaking with Lord Abbett Partner and Head of Tax-Free Fixed Income, Dan Solender. Dan, welcome to the show.
Thanks for having me, and thanks everyone for listening to us.
Again. Last time we spoke was in June. At the time, you spoke about a couple of things, Dan. Rates were sort of near all-time highs, I believe, or multi-year highs. We also had the very high rates of supply in the marketplace. Kind of walk us through what's happened since June in the market.
Sure, those themes have continued. We've had a really interesting year. We came into this year with rates being at the high end of where they've been for the past 10 years, and they're pretty much still in that similar range. We came in coming off a record supply year of around $500 billion last year, and we're actually ahead of that right now, and we're going to be ahead of it for the year. So another record year for supply. So it's been good. All that supply it's a great thing that all the infrastructure and all the financing needs of the municipalities and projects around the country are being able to be financed. But at the same time, all that supply does put some pressure on the market. And this year has been no exception for that, with the supply being high.
How about demand, the demand side of things?
Demand's been, there's been kind of a range of supply of demand in the market. We have, different ways that people can invest in municipal bonds. There's separately managed accounts, there's funds, there's individual bonds. And the separately managed account side has been booming in a big way, as has been for several years. Predominantly, that part of the market is focused on bonds 10 years and shorter. The mutual funds are really where the demand comes in for the longer part of the market, and that demand has been inconsistent. In 2022, there were huge outflows, and we're still trying to catch up from that. The money has not totally come back to the market yet. So it has had a strange impact on the market that you have this heavy supply, heavy demand inside of 10 years, and kind of lighter demand out longer. And a lot of the new issues come to the market with longer bonds. So you have the short end of the market and the intermediate part of the market performing pretty well, and actually outperforming the longer end where rates are higher, because those rates have to stay higher for all these deals to clear the market.
And how about the shape of the yield curve? I know we talked about that in the past, and how sometimes it's diverged from the taxable yield curve. Anything of note this year and looking forward?
Well, that's one of the strange things the last few years, when everyone kind of hears what's going on through their financial news, and they keep hearing about a flat yield curve and inverted yield curve. And we did have an inverted yield curve in the intermediate range a couple of years ago, which is now straightened out and is more normalized. But our market has actually had a steep yield curve for several years, and it's gotten even steeper this year. It's really kind of strange. If you look at the way rates have moved, 15 years and shorter on maturities, rates have come down this year, and pretty seriously come down inside of 10 years. Longer than 15 years, rates have gone up this year, so we've gotten even steeper, and the longer maturities have seen things get even steeper. So it is a strange dynamic where other markets have flat yield curves, where municipal yield curves came in here steep and has gotten steeper.
And on the performance front, I think last time we spoke, you mentioned that we've seen the taxable bonds had outperformed tax-free bonds in the early part of the year. But in the last couple of months, we've seen that kind of reverse a bit. And what's sort of the cause for that, you think, and do you see that continuing going forward?
For the year, it was starting to come back a little bit ever since September, when the Fed started lowering rates. We've seen things pick up a little bit, and rates rally a little bit more in munis. But for the year, tax-exempt munis have really still underperformed taxables. So for the year, it's still a situation where we're underperforming. So there is this opportunity. And it's actually kind of strange, because if you look at the longer maturities, you've had positive returns. They were negative back in September, but now you've had positive total returns. But that return has come from the income portion. With rates going up, the price portion has still gone down. And that's really been driven by this supply differential and that demand imbalance with supply. And things really changed in municipals a couple of years, well, not more than a couple of years ago, on the first Trump administration, when the corporate tax rate went from 35 to 21%. Banks and insurance companies used to buy a lot of municipal bonds, and now they're kind of net sellers in most environments. So that long end really depends on individual investors, and they're coming in, and flows have picked up since September, and that's kind of why we're rallying a little bit, but it's still a little bit of an imbalance.
And we talked a bit about supply and demand, some of the technicals there, and some of the yield curve factors as well. What about the credit backdrop? How's credit in this market?
Well, credit is actually very strong. You were coming off a time period, kind of going back a few years. We came into COVID. Everyone was very worried about what was going to happen. There was all kinds of outlooks that were going to be terrible, but the economy held up well, and municipals held up very well. And then you had all the stimulus money come in, which really helped for areas that were struggling a little bit. That money really held them over for a few years. So you've had these budgets coming in above and getting surpluses. You've had stimulus money. And then now we're in an environment where the stimulus money has kind of been spent and the budgets are still strong. So everything is holding up well. But we had a huge upgrade to downgrade ratio, a lot more upgrades to downgrades. Now it's more a little bit more upgrades, but not as out of whack. But that's really because the ratings have gotten so much higher. You have like the extreme, like in Illinois, which was triple B minus negative outlook back in 2020. Now is an A minus credit and is doing fine. New Jersey was kind of trending negatively, now it's double A. So the market is at a higher credit quality standard, which is a positive thing. And overall, that goes for everyone thinks the general obligations, revenue bonds as well. Everything is really holding up well right now.
Anything else to note around either New York or California, a couple of the large issuers out there?
Definitely. I mean, California is fascinating because, obviously there's politics in the country right now. So politics, we're always involved in that, and we're not taking sides. But and you hear about California's budget numbers, and anytime anything comes out, they're the fourth largest economy in the world on their own. So numbers are big. So they had like $100 billion surplus a couple of years ago. And what's interesting right now is that there's concern about different things, but they've increased their budget a big amount the last 10 years. But actually, their debt has gone down, so that they've become a solid double A credit. And even if there's some volatility in their revenues, their balance sheet looks so much better, and they've put all these money in reserve funds now too, so they have a lot put away to make it through times when things turn down. So California is doing very well and a very solid credit. You kind of get to New York. New York's an interesting situation right now. You have a new mayor coming in, but the main thing in the backdrop is New York went through some really tough times in the 70s, and all these controls were put in place to make it difficult for a mayor to have that much control. It needs a governor's approval, needs city council's approval. There's a lot of things a mayor can say, but not as much they can do on their own. So New York went from being a triple B credit in the 1990s to a double A credit now, and it's solidly in that range. And despite all the headlines, they're going to make it challenging. It is a very good credit and a very strong economy, no matter who's in charge of it.
And if we shift from like the view of either a city or a state lens and put on the view of the high yield municipal market, like the high yield section of the marketplace and the lower end credits, how's that holding up?
High yield's been interesting because starting on the supply level, we talk about record supply. That's been on the investment grade side. The high yield side is just seeing average supply. And that's because now rates are higher than they were a few years ago, and not as many projects are economical as they used to be when you can borrow it. 2021, when high yield rates were 5% or lower, it was a whole different situation than now they're 6, 7%. So your supply is not that high. Demand on the mutual fund side, that there is the biggest demand is high yield in terms of the fastest growing category for funds is high yield. So you have better demand than investment grade, lower supply. And then from a credit perspective, things are going really well. We have another year where defaults are in the 2% or lower range, which is pretty low for high yield. And with municipals too, you can kind of see distress coming a little bit differently than the high yield taxable markets, because when issuers get in trouble, they have to ask us for forbearance on their covenants. They have to ask to dip into reserve funds. It's a whole process before they get to a default, and we're not seeing much distress. That's really even lower than it was a year or two ago. So overall credit quality is good. And one final thing on that too, which is interesting. Everyone once again gets their information from other markets. On the taxable markets, you hear sometimes people saying credit spreads are tight. In the municipal bond market, credit spreads are not tight. There's a huge range of high yield market. There are certain very liquid issuers that are in the high yield market just because they don't have ratings right now. And then there are other like Puerto Rico bonds which are restructured for the most part, other than the Power Authority, trading yields around 5.25%. And then you have the high yield deals, and the rest of the market trading at 6, 6.5, 7, where there is a different spread. So the kind of long answer, supply and demand dynamics are pretty solid, credit quality good, and then this whole thing where spreads are still attractive for buying bonds.
And I guess in talking to your colleagues on the taxable side of the house and also in the private credit side of the house, we've all talked about some of the headlines that are out there that are getting attention, and the talk of course, the cockroaches in the marketplace and some headline defaults. These sort of maybe referred to a bit there. And we're looking at other markets. So do you see? It seems like there's a bit of insulation here in your market, even in the high yield sector, from what would be maybe seen as happening or concerned to be happening on the taxable side. Would that be accurate?
It is, and the starting point just for the whole market. You kind of look at everyone's like looking at Treasury, the federal government, how much debt they have, and the deficit growing, and you look at the numbers, and over the last decade, Treasury debt has gone from like 12 trillion to so like 28 trillion plus. So it's more than doubled. The municipal bond debt has gone from 3.9 trillion to 4.3 trillion. It's barely moved. So we don't have the same issues as a federal government, because state governments, local governments have to balance budgets. So they can't just borrow without balancing budgets. So on the investor grade part of starting point, they're in a much better situation. And then we do have a lot of things that are insulated from how the economy is doing. You have charter schools, which are students. So there's a huge demand for those. There's senior living facilities, which have some economics to them, but we have a demographics of a population where baby boomers are all getting to the age where they need places to move to at certain points. You have healthcare, which people need in all environments. A whole range of things like this and so that there's a lot of sectors that are just insulated from what's going on in the general economy, which makes it a good place to be in a range of environments.
So you mentioned a couple of the different sectors that you maybe see some opportunities going forward for an active manager like you all are. What about from a yield curve perspective? Do you see any parts of the yield curve look more attractive to you right now, relatively speaking?
People always want to ask us, like, where's the best place to be? And we try not to give advice.
Sure.
But my answer is similar in all markets, and it's a little more extreme right now because of our steep yield curve. But if you want the best returns, our yield curve is always upward sloping. We have this whole dynamic where the longer end is. So if you want better returns, better yields, and you can handle the volatility, which we've seen the last few years, there's always volatility. Over 3, 5, 10-year time periods, you're going to do better going out in the longer part of the yield curve. Just the whole benefit of the tax exemption. You look at the yields, the multiplier effect to get your tax equivalent yield. The bigger your yield is, the better that is. And we have a steep yield curve too, so you get a good return from rolling down the yield curve. If you're looking for the best risk return in terms of not taking as much volatility, but getting the best kind of like basic science, science of unit of return for risk, intermediate part of the market is really good. And that 5, 10-year range is really good for that. And then the final thing too is, like, we have a lot of investors out there who are saying, I think rates are going up. I'm really worried. I don't want to put my money. I want to leave it in my money market fund or my T-bill. If you go into the shorter part of the market and your bonds are maturing, and investment grade municipals have a default rate pretty much zero. Not saying they're always going to be zero, but that's what the default rates have been. Your dream in those bonds is they mature and you get to reinvest in a higher rate environment. So whether it's a ladder or something in that range, that short end can be attractive too. So I think there's a good place for everyone in the market, but to optimize returns the longer you go, but not a municipal bond. A lot of municipal bond investors don't want to take the volatility.
Any other areas of the market or things you're thinking about, either concerns or opportunities looking into as we go into 2026 here, that you're thinking about and the team's thinking about?
There's a lot of opportunity particularly on the high yield side, for different kinds of financing than we've seen before. You have on
Give
high
me an example, yeah.
Yeah, so like an example, like right now you hear about the private credit market, and we're not the private credit market. We're mark to market every day. It's a very different world, but we do have this thing right now. There are a handful of firms that are the larger investors in high yield municipals, which we're one of them. So there are deals now that come to a small group of us, and they want to finance the deals. They want to go to the place that have the assets to really put in place. So we have a lot of things where a hospital might be trying to do a financing in a different way than normal. An investment grade hospital, they might come to us and a group of us and try to finance it. So there is this opportunity on the high yield side where there's a lot more opportunity. The supply has grown a lot over the last few years, where there's so much more money in the high yield mini market that more things can be financed. So that's one thing that's interesting. And then just on the investment grade side too, credit quality is very strong. Yield curve is providing a lot of opportunity, and rates are higher than they've been in a decade. So pretty much, wherever you look in that market, you're going to get returns that are pretty strong compared to historical numbers in all markets.
It's awesome. Sounds great, Dan. Again, thank you for the time today. Really appreciate you sitting down with us and giving us your outlook going into 2026.
Thank you for the time, and thank you for everyone for listening.
This has been the Investment Conversation. Be sure to visit LordAbbett.com to find our complete 2026 investment outlook, along with other market and economic insights. Thank you all for listening.